Moving on, what else happened last week is that we had some housing data. It was interesting, and housing, as you would know, is a leading indicator for the entire economy. So I reached out to Andy from the Finding Value YouTube channel on here. I'd suggest you check that YouTube channel out. There will be another link in the description for that. But so Andy talked to me about the housing market in general because the data that came in, the way I understood it, both the building permits and then also the I believe the existing home sales, it was not as bullish for housing, or at least so I thought, right? But Andy though had a different opinion, so that was an intro. We ended up having a good conversation that helped me better wrap my head around where housing is going, and I even asked him for some advice on whether I should be looking to buy a home right now or whether I might want to consider going even heavier on uranium stocks. And it was an interesting answer. Here's what he told me. All right, Andy. So, two pieces of news really this week that I wanted to talk about here. One of them seemed bullish at first, and then the other one not so much. For the housing market, of course, in general. But so first of all, we got on Tuesday news about the building permits in the U.S., which that basically measures the change in the number of new building permits issued by the government. I guess that's what it is. That's how I understand it. But so those came higher than expected at 1.6. It's actually 1.685 million permits in June, a bit less than previous month though, and a bit less than, again, as I said, what experts were expecting. So what does that mean for the housing market, Andy? Is that important?
Well, I mean, that's so that the permits lead the housing starts, and it's not 100% conversion. So permits are dropping a little bit. We are seeing a little bit of a softening in the markets, but I don't think it's anything to worry about yet. It is still relatively high. It is still cycling above the average. The average is 1.45, 1.4 million, somewhere in that range for housing starts. The permits are basically what lead the starts. So as long as it stays above 1.4, I think we'll be in an inflationary environment greater than what we've seen in historical norms. So we're going to cycle back and forth as interest rates go up and down, and things cycle back and forth. With increasing rates, they'll drop a little bit depending on recessionary fears. And then that interest rate going up and down, we might be at a pretty close area. I saw your light go on and off.
Yeah, I know it's annoying.
We could be cycling back and forth, kind of about, above the average for a while, and then we might take off again later on. It highly depends on sentiment, highly depends on interest rates, but the market imbalances between the supply and demand, the larger demographic coming forward, is still there. It's just a question of affordability at this point.
Okay, that's a very good compact overview, and I like that. I do want to touch upon a few points as we move forward, but I just want to talk about the next news that we had that might be even more important. And I guess it was that, I'm just thinking how to word this, but there were basically the existing home sales is what I want to talk about, and that's in the US, but those came in short of expectations again at 5.1 million, and that's against a 5.4 million homes in the previous month. So let me maybe just ask that. That's about 300,000 less, right? This is the biggest drop in 4 months, it said on here, and it marks the 5th month of declines in existing home sales. So what does that, doesn't that mean that demand might be crumbling already? And isn't that making you more curious about what's happening in the housing market?
Well, what I usually look at is your inventories. The sales, I don't really look at as much. So it's, what do you have in inventory? And if we are going to be coming to an ending of, we'll call it the housing market, we should be flush with inventory. And what that means is, if this housing bull market is done, let's say someone's wondering when the inflection point is. That inflection point happens at greater than 6 months of inventory on a regional basis. So 6 months is a balanced market. If you start going above 6 months, you hit more like 8 or 10 months, then you've got a problem. But we are still very low on inventory at this time. We're at like 2.5 months, 3 months, I think, whatever it's at. I didn't check the actually. is it 3-4 months? Somewhere in that range, I think, is where we're at. So we're still below the 6-month average, which they consider to be a balanced market. It's still a seller's market. Prices are still going up, but we are obviously seeing softening in the market. So that's what we're seeing. We're starting to see some of these inventories build back up a little bit. So interest rates are having an impact along with higher prices. Prices are continuing to go higher. They have not pulled back.
Right.
And inventories, once they get above 6 months, then I would say, look, we're probably coming into an area where we could see the pricing really start to soften.
Okay, so you're using there goes my light again. I'm saving up on energy because the prices are high. No, but so you're okay, you're using inventory instead of trying to predict demand, because that's gonna tell you more about the prices. I think I understand that. I think you've told me that before. But there's also something else that I found something interesting. I don't follow the housing market. I have not followed the housing market as much. I'm starting to gain more interest in it because I see how important it is for the overall economy. But so the Mortgage Bankers Association also released a report on Wednesday, I believe, and it showed that the mortgage demand is at its lowest in over 20 years. So, though inventory might be low, the demand already seems to be falling back. So isn't that telling you something, at least? I mean, maybe not a lot, but at least something.
Yeah. So maybe I'll describe the situation and why I use housing as a leading indicator. So what I look for is the volume of home loans into the system. That volume is inflationary or deflationary, but it takes, say, about 18 months for the M2 money supply to work its way through into the inflation number. So you have an 18-month leading indicator with housing, if that makes sense. So we can see these things move all over the place, but on the short term, even if they're pulling back some, you wouldn't have to worry because you still have an 18-month lag behind it. So if that makes sense for the inflation deflation into the system. Also, we've had a very sharp spike in interest rates. We'll call it mortgage rates very quickly. So the market's trying to digest that. We also have, quote, recessionary fears out there. So we don't necessarily know with 100% certainty that the homes coming onto the market, if this is people panicking and they're trying to sell all their houses right now because they think a recession is going to come. And then after this panic, and let's say the panic subsides or goes away, are we still going to get the continued selling pressure in the housing market? People selling homes, because we've seen a large increase in homes being sold, and that's how our inventories are coming back. As interest rates go up, mortgage rates, I would assume that the demand for mortgages would go down. So I don't see any problem there per se, but it depends on what you're looking at. Are you looking at mortgages for new homes? Or are you looking at total mortgages that people are applying for? If it's the total mortgages that people are applying for, well, then that's quite obvious that people are going to not refinance under a much higher interest rate, mortgage rate condition.
Right.
So I would suspect that the demand for loans would drop dramatically in an increasing interest rate environment.
Right. Okay, that makes a lot of sense. And sort of, well, let me maybe sum up to you what I understood from, I want to say maybe 2 weeks of looking into this, but not aggressively, just sort of reading news articles. The way I understood it is that many people bought houses that were bigger than what they intended because of being, cramped in a smaller house during the pandemic lockdowns. The lower interest rates supported and their increased collateral as well supported more loans, basically increased collateral because of the stimulus checks. So more and more demand was created by a situation that would normally not have taken place. The virus, nobody expected it. That was the thing that dried up the inventory, and that made housing go up. But all of this seems to be changing now. I mean, at least that's what people are talking about on those articles, is that, especially on top of the Fed aggressively raising interest rates now, potentially more aggressively than expected. That's happening while the prices are already higher. And that's on top of inflation, which raises the cost of living for everybody on top of their mortgage, right? And thus makes banks, I guess, less willing to lend at higher interest rates for more expensive homes, which has resulted in that. And in the housing inventory, although it is very low, as you said, what I checked is that it has been rising every month this year since February, I believe. So that's sort of the image that I'm getting, and it's like, okay, you're right. Housing market is not crumbling yet, but it looks like it might be crumbling soon. That's sort of the conclusion that I arrived to. But you're saying that it's too early to make that conclusion. Is that right?
That's my take on it. Yes, because we don't have the inventories to be at a level where I would be concerned of prices actually going down. So I think they're going to continue to go up as long as we're below 6 months of inventory. They're going to continue to go higher. We have zero data points saying that the market would go lower under 6 months of inventory. It's always gone higher. So it's gonna have to hit that point and then exceed that point for us to go into quote a bear market in housing. What's happening is the demand for loans. This is just a free market. If we had a free market, the demand for loans, you would see higher interest rates as your demand for loans would go up. That's inflationary too. So inflation sparks increasing interest rates because it puts it in a real negative yield. And then your 10-year yields and on bonds would all go up. Same with mortgage rates. So they're all kind of linked together. What people are saying is we've dramatically increased the interest rates quite dramatically in a very short period of time. They've kind of rocketed higher, and things have slowed down. And that's what we're seeing. We're seeing the slowdown of, we'll call it the affordability getting even worse. But you could also say, if you were to twist it backwards, that the worst housing crisis that any humans, would see, we would have the worst affordability. So the question is this affordability a reflection of the imbalance in the market? The answer is yes. But now they're trying to hold this all down because we have inflation in the system. And the way that they fight inflation is by increasing interest rates. And that increasing interest rate is going to balance it all out through the affordability. So we're trying to find that balance. And right now, we're starting to see that we're getting closer to an inflection point of that balance where housing inventories are starting to gain in inventory. But we're still at a low level. So is this the top or not? And I don't think anyone knows that answer. I think it's premature to say that we're just going to go straight to a housing crash. I don't think we're within, 12 months of a housing crash. So when you call a top, when would it be the right time to call the top? I think that there's still a little bit more time in this. If there is going to be a top, we still have the imbalance in the market. We are still short homes. So I don't think that the problem has necessarily been solved. It's been delayed because they're holding it, basically the prices, they're holding them, I think the prices will slow down as interest rates go up, which is normal in a market. The market doesn't act like the stock market, the housing market. The market, in terms of the housing market, we don't just go from 20% increases and then go down 20%. It's not that volatile. It's not that fast. Think of it as a coin flipping. And if I were to flip a coin off my finger, you have max velocity off your finger. Consider that to be the housing prices. So you get the greatest velocity is right when you get the inflection point between a recovery phase and an expansionary phase. You get the greatest increase of pricing pressures at that point because you've eaten through all your inventory, and that inventory has to basically come back. And right now, we were passing that inflection point in 2020, 2021, and now we're starting to come into higher interest rates and where people are starting to slow down because of the affordability. Inventory's coming back, but we're still at low levels. I'm not ready to make the jump or the conclusion where you just go straight to a market crash decline. I'm not there yet. I have to see 6 months of inventory or greater where I'm like, all right, this is done. Where we could potentially head lower. We could be putting in a top. But if the imbalances are still there, what are interest rates going to do a year from now? I mean, that's basically what people are betting on. They're saying that interest rates will continue to go higher, and that the market will come on back. But here's my question, that back to everyone else. If the rates go higher, you're going to get a recession. You're going to get a contraction in the economy. You're going to get all that stuff. You know how they respond to a contraction in the economy? They lower interest rates.
Right.
If the imbalance is still there and they go back and lower interest rates, well, what happens to the housing market? It goes back up.
Right.
If the imbalance is still there, which I think it is.
Hmm.
So everyone who's calling for the housing market crash is basically betting on interest rates continuing to go higher, and that the government and everyone else won't basically lift off the interest rate pedal. I think they will, but that's an opinion there, and I'm speculating on that. But I just think it's too early to say that this thing is completely done.
That makes a lot of sense. It's just a completely different view than most of what you'd find out there. I do find, though, and this might just be related to views and clicks and stuff like that, is that fear mongering, gets a lot more views, gets shared on a lot more places. I've noticed there's some channels on YouTube that do that as well. As that the content gets kind of boring, but as long as it's fear mongering, a few of other websites are gonna pick it up, and you're gonna get way more views on YouTube than what you would normally get. Like, a channel with, let's say, I'm not naming any particular channel or anything, but let's say they got 50,000 subscribers, they get 70,000 views on every video. It's like, where are all these views coming from? It's because some of the fear-mongering big websites, I don't want to name any names there either, but they also pick that up. And so maybe that's why it's like that, because I believe that a lot of the previous recessions have followed a housing crash. Is that right?
Yeah, so it's the crash in housing starts that then a recession usually follows that almost always, because your loan volumes go way down. It's disinflationary or deflationary depending on the loans in the system and what happens to them. So we're in a far different situation than we were in 2008. And what I mean by that is we don't have delinquencies coming up. We don't have foreclosures that are high. We have low interest rates that are all locked in. We have people with much better credit, much more affordability. We have a whole bunch of cash in our banking system that people have access to.
Right.
And so I don't think the market conditions are the same. What happened in 2008 is they gave loans out to everybody who couldn't afford them at all. They couldn't afford them even if the rates stayed low. They were all just, it was I'll call it the speculative orgy that just blew out all these loans.
Yeah.
And then what happened is people started to get underwater, and they couldn't afford the house anyway. They had no equity in the house. Right. So just dump it. So everyone dumped it. And then that made the problem worse. So they got underwater. The price started to come down, and everybody just started dumping homes on the market because they couldn't afford it. So now if you've got a bunch of equity in your house, which most people do at this point, if I were to make a comparison of where we are to last, we'll call it bubble, we're like in 2004 or 5. Like we're still coming up where the inventories are starting to come up, or maybe it was 03. Maybe we're in 02 or 03, where the inventory started to come up, and it had a long time before those inventories really started to blow out and the prices started to go down. So I think there's still years left in this market, and we may have 8 years left. It depends on what the inventories do and what the interest rates do. And I'm not yet in the camp where we're just going to crash in like 2 or 3 months. I just don't think that's possible. We have the prices are still going up, and they're going up double digit paces, 10%, 9%, something like that. So that's got to all slow down and reverse.
Right.
I think people are way too quick. This is a slow moving market. This is like moving the Titanic. All right. We're not in a little speedboat where we can just turn around and go the other direction. Like, this takes a whole bunch of time to turn.
I wasn't a home buyer in 2008. I'm not a home buyer now, so I have no idea how that is. But is it harder to take out a loan to buy a home right now than it was in 2008? Like, are they doing more checkups? Because something that you said just a moment ago is where everybody gets a loan in 2008. I remembered of that scene of the Big Short where the three guys go to another guy's home and they ask for the owner, and the guy's like, why are you asking about my the owner of the why are you asking about my landlord's cat or something like that, which made the point that they were giving out loans to everybody, even to cats. So has that changed? Are they not giving out loans to cats not these days?
Yeah, so all of those loans were like in 03, 04, 05, 06, and then they all went bust in like 07, 08, 09, 09, 10, and so on.
Hmm.
So we have, I think the percentages of loans that are like those loans are like less than 5%. In that time frame, it was way high. It was like 60, 70% or something like that.
How do you know? Is that, I'm sorry to
Increasing.
interrupt here, but is that a metric or something that I could look up or use for my analysis?
Yeah, you can see how many people are taking out um, those more exotic loans. So
Hmm.
it would be uh, loans like arms and stuff like that, adjustable rate mortgages. And I'm sure they're going to increase at some point here because that's just how it works. As affordability goes down, they start getting more aggressive on actually lending.
Hmm.
But I mean, that is something that you can monitor and look at for the adjustable rate mortgages.
Okay. Okay. And that's sort of the medium term future that we're talking about here. What if we were to sort of zoom out a little bit to a longer period? I guess the best question here might be a who question. Like, who do you think is driving housing in terms of demographics right now? Because I heard something that baby boomers still have the highest percentage of housing ownership. So is that gonna change? What do you think is gonna change when millennials start coming to that point? Are they gonna be owning homes? What do you think about demographics?
I think the demographics are favorable because you have more millennials than you have baby boomers, and you're going to have the family formation is greater than the family of the single family unit homes that are available in the system. So
Hold on,
there's an imbalance
I
right
don't
now.
think I'm following there. The family, oh, you mean that there's more family homes than there are single family homes or something like that?
There's more families than homes available.
Oh, okay, okay.
So yeah, the demand supply, there's an imbalance there,
Hmm.
and they're coming into home buying years. I know some people they like to look at the demographics, and then they show you this chart, and it shows that the population is coming back down in terms of percentage, in a percentage like Gen Z. Percentage wise, it is coming back down. That still means there's more people, but there's also 10 and 12-year-olds don't buy homes. So it's the data they're using is not right. It's a moot point if there's less 5-year-olds and you've got a larger demographic coming into home buying years that are 30, 35 years old. So that demographic's coming to home buying years, and we've got far more people living in basements of people's homes. So at some point, you'd think they'd move out. Maybe they take the home. Maybe they'll inherit a home from some of these baby boomers that pass away. But it's still an imbalance in the system. We still need more. And I know some people say that we have more homes than family formations, and some people own multiple homes, and that is true. But there's no reason for someone to sell their house necessarily if it's up in a lake somewhere that someone's not going to use anyway. So I don't know. It's the arguments on we have more homes than people. I'm sure that might be true, but it's not in the right locations. So I'm in the camp that we still have an imbalance, and this imbalance has occurred since basically since 2009, 2010. Our
Hmm.
inventories have continually come lower and lower and lower and lower throughout that time frame. This trend's been intact since the last bust, and inventories have declined every single year since that time frame. So this isn't like something happened in 2020 where the inventory just went to zero. This has been a trend in place the entire time. Now the trend may have to go back up in increasing inventory. The question then you have to ask yourself is, well, what's the rate of increase on the inventory, and is it solving our problem? Just because something becomes less affordable doesn't mean that the demand just goes poof and goes away. They may be forced with other difficult decisions that families have to face in the future. For instance, if people can't buy homes, there's going to be a greater propensity for renting. So you're going to see rent prices go up. If rent prices go up, now that puts the person in a different situation where they say, do I rent the place for $3,000 a month or do I buy it for $2,800? It's still, a higher price and less affordable, but now you're faced with the problem of, do I rent or do I buy? Maybe they can afford it, maybe they can't. That's not my decision to figure that out, but it's what I look at, the true demand supply balances are seen through inventories. So as long as you're looking at inventories and as long as they remain below 6 months, you are in a seller's market. We are still in a seller's market, even though it's softening. And then if you look at the housing starts, if you're above 1.4 million homes, you are still in an inflationary environment where the volume of loan growth continues to add to the system. It just might not be at as high of an inflation rate as it was if you build 1.8 million or 1.7 million homes. But you're still in an expansionary phase of real estate, and that can go back up. It can come back down. It can cycle all around. I don't think what people do is they take one data point. If they have 1 or 2 data points and it goes down, they'll say the trend is done. We're going to just go to zero. They're either total bull or total bear. What I'm saying is I'm living in the gray right now, where we go sideways for a while. Okay. Things are trying to digest these large market moves in terms of mortgage rates, in terms of all this stuff. And if you have recessionary fears in the market, which we do, a whole bunch of people are going to say, sell the house. I don't care. Just sell the house. So they're going to try to maybe front run this recessionary fears depending on their sentiment, because some people think that the housing market is slowing down and that they want to sell their house now. So you might get a larger influx of inventory right off the bat than say maybe 3-4 months from now. But that's me speculating. I don't know that for a fact, but that's why I watch inventory levels.
Well, maybe I can tell you this from my perspective for what it's worth. I don't think it's worth much because I'm not the brightest of bulbs out there. But if I had a home right now or whenever, I wouldn't really be looking to sell that. Or I do hear about some people like, oh, I'm going to sell my home right now. I'm going to go all into gold and silver. I heard somebody kind of famous here on YouTube did that a couple of months, maybe even a year ago. I think they regretted because homes have gone up, gold and silver has gone down. But I guess what the sort of the issue might be, and this one of my buddies, Kirk, he also wanted me to ask you this about the corporations that are picking up single family homes. And if you combine that with millennials being less willing to marry and settle down and have a family and all the gender, whatever thing it might be, I don't really understand that either. But isn't that concerning you, that pressure in the market that might be coming from the investment side? Because again, I'm going to tie this up, is that if I had a home, if I owned a home, I would not be buying and selling that. Like I would not buy it because it's really expensive, or I would not sell it because it's really expensive and try and buy something else. But if I'm investing, if I'm an investment bank or an investment whatever entity, that's what I do. I buy and sell homes. So that's not worrying you at all that there's corporations buying up single family homes out there?
They probably have the viewpoint similar to me, is that they think the home prices are going to go up and we're coming into an inflationary environment. So the way that you protect your wealth is I can't hold bonds at that point, because if we come into an inflationary environment and interest rates are starting to go up, you're losing money in bonds. So if this environment that's coming up is inflationary and they think it's inflationary, they have to redeploy money somewhere else outside of bonds and stocks. So where else are you going to put the money? If you have a demographic that's larger and you have a housing shortage, well, let's just go buy a bunch of homes. It's a way to, and if it's an inflationary environment, you take out loans. If you loan money, your mortgage rate, your mortgage will get inflated away, your payments. If you have a fixed 30-year fixed rate mortgage at a very low rate, which I have, they're just going to eat it through inflation. Right. Now, here's the problem that I have. I would not sell my house. I'm not selling my house. I bought my house back in the mid 2010s. Nice. And it was cheap. I refinanced to a 2.75 fixed rate 30-year loan. So my payment is really low. Now, my option right now, if I were to sell my house, they'd say, great, you have a gain. But when I go buy something else, if I were to buy something else, it's still going to be expensive. And I'm going to lock in a much higher interest rate.
Hmm.
Now, if I go and I sell my house and I say, okay, I want to lock in the hundreds of thousands of dollars that I gained in my house. So then I lock it in, and then I'm going to have to go rent. Now that rent price, if we have a great inflationary environment, what if your rent prices continue to go up? What if I'm paying $5,000 or $6,000 a month for rent when I'm paying $1,000 a month to own the house in a fixed rate mortgage? There's more risk for me to sell my house than there is to me just staying. And that's from the risk of my costs going up. So for me, if just from, I'm a engineering type background and stuff, I want to fix my costs as low as I possibly can.
Right.
I don't really care about the price of the house. So fix my costs as low as I can, let the inflation eat it away. And
Right.
that's what I'm doing. That's my strategy.
Right,
Wrong,
right.
or indifferent.
But
Yep.
so that's what I would do as well if I were in your position. But what I'm asking about is, what about the market condition, the home owners that are now changing from it being people like you and me? I'm sorry for comparing you to myself, by the way, but from it being people like you and me to being corporations who want to make profits. Do you think that going forward, long term, that's gonna change the way that the real estate market behaves? Like, is it gonna make it more efficient or less efficient?
It's a good question. I don't know if I have, the direct answer on that. In terms of efficiency, I do think that I think home prices, if you look at it in relationship to other assets, their home prices are still very cheap. They're cheap in relationship to gold, and it doesn't mean that it can't get cheaper, but it is cheap historically against gold, and I think it will get cheaper over time probably. It's cheap in relationship to stocks. It's cheap in relationship to bonds, and all the money's over in bonds and stocks. If those investments don't work, where's the money going to go? That's what you have to answer. If those investments are going down and they're going to sell those investments, where's that money going to rotate into? And you're seeing the financial places do that. They're rotating and buying real estate. That is more or less another metric or more information and data saying that they believe that an inflationary environment is coming. So by them positioning in real estate, in my opinion, is saying that they believe that real estate is, one, a store of value, and two, that they're also thinking that we're coming into an inflationary environment and that we have an imbalance in the housing market. Otherwise, they wouldn't be there. If they thought that the balances were good and that the loan growth and all that stuff wasn't going to happen in the future, they wouldn't park a bunch of money in real estate. They would sit it in bonds. They're not in bonds. They're selling bonds. That's why interest rates are going up. But in the short term, I'm looking at things from like a 5-10 year perspective. In the short term, we could have a recession. People could run to bonds. Things could come back and pull back for a little bit. I just don't think it can stay down if it does, because interest rates will come back down with it.
Well, but how does something like stagflation influence the housing market, though? Because that's a possibility, right?
Yeah. So stagflation is basically driven by the housing market. So that's the economy that's slowing down. You have an imbalance in the housing market, and the housing market continues to rocket higher, which is the inflationary driver. And that inflationary driver pulls interest rates up with it. So it's more data saying that the housing market is strong and the demand for loans is strong. But you can have increasing unemployment at the same time you have increasing home prices, just like the 1970s. So they had increasing prices go up because there's a supply-demand imbalance in the market, even though unemployment went up with it during the whole 70s.
Okay. That's an interesting point. I have not gone back to look at the history of what's happening. Maybe I should do more of that, base myself more on data, use more inventories rather than thinking about what's the narrative for the future, because nobody has a crystal ball. Yeah, that makes a lot of sense.
Yeah. Just if you want to, my opinion, not financial advice, if you want to make money, don't focus on narratives. Don't focus on the demand, the demand side of things way out in the future. Look at the balances that you have today and how those are interacting with each other. Are we declining our inventories over time? If the answer is yes, it means that we're underproducing whatever that market is. And once you get to a certain point of inventory, that's when prices start to really rocket. So if you were to look at the housing market, we were declining from 10 or 12 months of inventory from that, we'll call it that bad oversupply of housing. We declined that inventory down and down and down. And once the foreclosures ran out, and once we had the inventory run out of inventory, prices started to rocket. Then we got to really critical levels in 2020 for whatever reason. People can say it's interest rate driven. It doesn't really matter. We went to a level that was critical in inventory and we started to really explode higher. Now our inventories have to build back up, but it doesn't build up in 1 month. It takes time for it to build back up. So I'm watching those inventories build back up. It doesn't mean that we're just going to go straight there at the rate of these past couple of months. Maybe it does. Maybe we go all the way to 6 months very quick. I'm just not ready or willing to jump to that conclusion when you have all this time in the world to react to it. Mm-hmm. There's no point of panicking. There's no point of basically selling everything, because a lot of things can happen in 12 months or 18 months. I mean, if you were to look at the uranium market to compare to housing basically peaked in 05. It was like 05, 06, and it started to roll over. And the big crash came in 08, because that's when all the deflationary loans going bust and all that stuff. We're still in the upward movement. So we're like, if we were to compare to 08, we're still on the left-hand side of that move coming up. So we're like in 02, 03, 04, however you want to say it, somewhere in that range. And we're coming on up. It's gonna turn and go back down. But the entire uranium bull market and some of these companies, they went up in like 06, 07, and they went up like 20 times their money. They went up when the housing market was coming basically back down or flattening. So a lot can happen in a 12 to 18 month period. And that's why it's so important to get this stuff right, because the housing market's the leading indicator, the driver of all this stuff of inflation. Once your driver ends, you got about 18 months past it. But they are playing with the Federal Reserve is playing with a bunch of stuff in this market. They're manipulating far more things than they've ever done before. I think they're in there doing quantitative easing, quantitative tightening. They're buying assets. They're doing stuff that they didn't normally do historically. So they are in there manipulating things. They're doing strategic petroleum reserve releases. They're moving things around, which are playing with our leading indicators. The 10-year, they're probably in there buying the 10-year yield. So the past couple of days, as it's dropped, is that a legit signal saying that people are afraid of a recession, or is that them in there buying that stuff, trying to hold the rates down because there's some other tertiary problem in the system? Because I know the ECB's in there buying stuff, quote, fragmentation. They're in there buying bonds and doing yield curve control. I think the Federal Reserve is in there doing it as well. And they were supposed to start doing that here just this past week. Mm-hmm. So it's difficult to say how this is all going to play out, because we've got an entity controlling everything, or at least trying to. And if they're successful at holding the 10-year yield down, well, that's going to help the housing market. It's going to be inflationary. One, they have to create money to buy those bonds, which is inflationary. And two, they're going to hold the interest rates down while inflation will keep going.
Right.
So if inflation's high and they hold the interest rate down, which is you're holding your mortgage rates down, that's going to be beneficial to housing.
I wanted to close off the interview by asking you sort of a question of what will you do, but let's make that a bit more silly. Let's make it title worthy, because you were mentioning uranium. If you were my age, and I'm not in the US, but let's pretend for a second that I am. If you are my age, I'm 26. I don't have kids. And would you be putting money down to buy a home right now, or would you be investing all that money into uranium stocks?
Like this second right now?
Yes, like just if you were 26, no kids.
So in 2020, I'm just going to go, someone asked me that question, and he is 25. He said, what should he do? And he had like $50,000 to $100,000 or something. I told him in 2020, I said, this is what I would do, and this isn't financial advice, it's just what I would do. I told them I would buy a house, I would get a fixed rate mortgage. At that time, it was 2.75%, 2.65% in 2020 or so. And then I said I'd get a renter or two, rent out those rooms. They would pay your entire house off because you're young and you can have, he wasn't married or anything. So he could have those people charging $600 a month, pay off the majority of his mortgage. He would live there maybe $500 a month or something like that for insurance, property taxes, whatever else. So I would definitely do that first. Then I would choose the most probable bets in the markets with the lowest risk and dump money in those. So uranium is a higher risk bet. That's kind of like high stakes gambling, so to speak, because they don't have the incomes. They don't have revenue. There's no free cash flow being generated in a lot of those companies. So you're taking on a lot of risk. Mm-hmm. So I would take a lot of money, and then I would try to do maybe like physical platinum or something like that has very low ratios and very low risk. Because if you come into an inflationary period, it does pretty well, and you can just do the ratio game of swapping between metals. Then I would take some other money and swing for the fences. I would say, all right, I'll put some in uranium. I'm going to swing for a uranium exploration company that's hit something in the ground already, and I'll put a good chunk there. I'll buy some oil companies, some natural gas companies that are very leveraged. And I think natural gas is a very good spot to be looking at right now in America, because there's a big dislocation between Europe and where we are. And when those liquefied natural gas terminals come back up, it's going to connect those prices back again. So the way that I would play it is, buy the house, lock in your cost, get it low, get some renters in there, rent it out. And then I would do a low risk, put a lot of money into lower risk, more for sure bets in the system. Then I would pile on a bunch of risk stuff with lower amounts of money to swing for the fences, and then spread it across those. That's basically what my portfolio is right now.
And you would still do that if you were starting right now, despite the interest rates being higher.
So then you're going to have to figure out what those costs are. So, and I don't know what the rent prices are, because I know the house next to me is renting for $3,200 a month. And then you have to look at, well, what can I buy the place for? I think, and it depends what your down payment is. I still think that at home prices, I don't know if the imbalances are fixed in the market yet. So you're going to have people start doubling up. They're going to start getting roommates, and they're going to start renting places. So I think that home prices won't necessarily just crash like a lot of people think. They could slow down, they could go sideways, but that still means that every single month, if you have a family, I have a family, I have to rent a house. If I were to rent a house, I have to rent something, and I can't I can't get roommates at my age, and I have kids and all this stuff. So my decision for someone like me is, do I go rent something for $3,000 a month, or do I just go buy something? I would buy something even today myself, but that's me, because I want to lock in the rates. Now, if interest rates drop, guess what I do? I get to refinance the house. If they don't drop, then I lock in my costs where they're at, and then the rent prices, I think, will continue to go higher, because the next door, they've had multiple people rent that over the years at higher and higher prices. So I think that the risk for me, if I were to rent, is that those prices continue to go higher. And if people can't buy homes, if they can't afford to buy homes, it's going to put more pressure on the rentals. So that's my viewpoint on it. And maybe I'm wrong. Maybe the housing market crashes and the rental market becomes a lot more expensive. It's difficult to say, but for me, I would still buy if it were me, and you could lock in your costs, and you got a good deal, and you got a house that you like. That's me though.
No, I get that. And I remember reading something on a website, and I just found it. So I want to read it off to you, and you tell me if you think that's reasonable. Now, I'm reading this off investopedia.com. It's called the buy to rent ratio, basically price to rent ratio, they call it. And they're saying that you should take the total cost of home ownership, which factors in mortgage principal, interest rates, property taxes, insurance, closing costs, home owners association, mortgage insurance, and tax advantages. So all that, you factor all that in to decide what the as well as the mortgage interest deduction to figure out what the total cost of owning that home would be, and then you divide it by the price of a comparable place that you can rent, basically. And so they've established a threshold for the ratios that a price to rent of 1 to 15 indicates that it is much better to buy than rent, and a price to rent of 16 to 20 indicates it is typically better to rent than buy, and a price to rent of over 21, so 21 or so 20 or more, it indicates it is much better to rent than buy. Does that make sense?
Yeah, it's the price to rent ratio, but
okay.
That ratio also will move with time, and it depends on, usually home prices move first and then the rents start to come up at a faster pace after. So at least that's what it's been historically doing right now. I mean, that's the past year or two. I think rents are going to go up at a faster pace than home prices at this time.
Okay.
Yep. So I think it'll be home prices shoot up and then rents will catch up as people can't afford to buy. And that's, you're kind of speculating on that. But for me, when I look at it, I'd rather buy the house, lock in the cost, and let the rent prices do whatever the heck they want. If I know I can afford the house and it's a good value to me, why not lock it in? That's me. And if something happens in the market where we get a recession here, maybe rates go down and you get to refinance and lower that mortgage payment that you have. I mean, that's what I did. I bought when rates were like 4% or something like that. And then I bought the house. I said, oh, this is cheap. So I bought it. I was holding on. And then in 2020, it all crashed out. And I refinanced at the bottom of the market. And I got 2.75. I think the bottom of the bottom was 2.65.
Nice.
But and it didn't cost me anything to refinance, because I went at a 2.65 and then they gave me points back because I said, oh, 2.75 is fine. I want to reduce the cost of refinancing, and it didn't really cost me anything. That's how I did it.